Hey, how's it going, guys? Welcome back to Capital Mindset. Today we're doing a short segment just with me, your host, Fabio. And today we're going to be talking about the quick update on what's going on in China and the Evergreen. Think of this as a part 2 to our original video. I'll leave the link down in the description below to that original China video. And we're going to be discussing, for example, what's going on in China, what are the implications, how does that affect you as an investor overseas? And what we'll first start is with the Alibaba stock price. Now, this is a popular stock owned by a lot of retail investors. We discussed this briefly in previous videos, and we have an article up on our website about China and the implications of investing in China and what are some things you want to consider as far as risks. Now, you can see here that Alibaba is dropping about 6.37% today. The market's still not closed, but it'll close in about 30 minutes. We have about 30 minutes left, or more accurately, around 37 minutes. And we can see here that it's reacting pretty drastically to the Evergreen situation, which over here, I'll pull us over to The Guardian. And in The Guardian, they're describing it as the Lehman Brothers moment, right? Harkening back to the Lehman Brothers situation that the United States went through back during the Great Financial Crisis. Now, do I think this will be a problem for the globe long term? No, I do not. The debt that's at risk here is about $300 billion. Now, you got to remember that the entire financial system is more or less connected at this point. So something happening in the second largest economy in the world does have implications for the rest of the world, just as something that happened in the United States had implications for the rest of the world. Now, I'll point to this article that we wrote. The original article was written in July 17, 2020, and the stock price of Alibaba was around $250 when it was originally written. Real quick, we'll actually go to the model to kind of talk about Alibaba and whether or not Alibaba is a good investment or not, or on a valuation basis. And right here, everything's already kind of plugged in. We see the assumed growth rates be from 20 to 40%. So I actually believe that the business itself is capable of growing its operations at a clip of about 25% or above. And if your required rate of return is around 20% per year, which is about 600% over the course of 10 years, then that's actually the buy price the model says we should buy. Now, the model lacks nuance. So what is the nuance that I'm talking about? Well, in that first video about China, we did discuss some of the problems with investing in China, one of them being the VIE structure and how you don't really own the underlying business and how that can be a problem. Because if you, for example, if I have a business and I say to you, hey, invest in my business, and what do you get in return? Well, let's say in this case, you get nothing. Now, what are you willing to pay for the business? Well, your answer should be nothing, because you don't actually own the business. Now, understanding that is kind of going back to what Warren Buffett has always been teaching. It's about investing is about owning businesses, any kind of investing. So if you're investing in real estate, it's about owning that real estate. If you're investing in bonds, you're owning the bond, you're owning the debt. Well, if you're investing in a business, you better own the business, because if you don't own the business, what do you really own, right? And there's a difference between property law and contract law. And we actually go through this in the new article that we're writing about this. It's a part 2 to the previous article, going a little more in depth onto the legal implications as far as what are your protections. And a little bit of a spoiler alert, there aren't many. So what does that mean? Well, that means that it doesn't matter that Alibaba is trading at a fantastic price relative to the underlying business. It doesn't matter. Why? Because I can't own it. So the model lacks that nuance here. Now, if I could own it, I would be buying it, because it is at an appropriate risk reward. And I believe if I discount it to, let's say 25%, I still believe it could easily grow at between 25 or above. And I think 30% is actually 30% growth rate over here is actually pretty reasonable. And that's assuming no buybacks. But I do assume Alibaba to do share dilutions going forward, even though they're profitable on a net basis, just because if you and I were able to raise capital without giving up ownership, I believe, morality aside, that we would probably do it. And I assume that all Chinese businesses are probably going to continue to do so. So the whole risks of the VIEs being restricted by the Chinese government, I think that is completely unlikely. And that is being said by people who don't fundamentally understand what the VIEs are. Why would they stop that? That's fantastic for them because they're getting capital from the rest of the world to build their businesses without giving up ownership. I would personally, if I was running the country, would continue that process for as long as possible and extract as much capital from the West as long as possible and build up my enterprises. And then way down the road, maybe do something about it. But if I could go on forever, I'd probably do it, because I'm not actually giving up ownership. So when our companies go public, they're giving up ownership in order to raise capital. So basically there's a cost to the capital, but for the Chinese businesses, there's really no cost to that capital they're raising. So that being said, if anything changes regards to that, I would be a buyer of Alibaba. Do I think there's going to be changes? No, I do not. So for me personally, no Chinese business is a buy for me, regardless of the price, because I'm not actually owning the business. Now, there's one more thing I'll add, and we'll actually do there's an upcoming video that we're going to be doing about Disney, Wynn Resorts, and Las Vegas Sands, where we're going to actually get into something that no one really talks about here in the YouTube community. For whatever reason, it's mainly because they just don't normally read the SEC documents too in-depthly. And I'm going to give a lot of credit to my business partner, Austin, who actually, using his auditing brain of his, he went through those SEC documents and he found these little places where they're disclosing it, but they're not really highlighting it as much as they probably should be. And as much as the investor base should really know what's going on. And we'll get into that in those videos. But what I want to get through here is some of the capital restrictions and what that can imply for businesses, American businesses, or any business around the world doing business in China. So I'll highlight this article over here that gets into it a little bit, and I'll actually input my own statements here. But when you want to take money out of China, you need to go through something called the State Administration of Foreign Exchange. We'll abbreviate it for SAFE, as they do here. And basically, it says there that the citizenry or individuals can remove or take out $50,000 per year from China. And we'll get into this, what this means with crypto at the end, because there's a reason why crypto is falling today. But what this essentially means is that if you are an individual and you want to get money out, you have a limit of 50,000. Anything past that has to get specific approval, and that's to control the capital outflows. Well, businesses, they don't really go into this here, but businesses have around, I believe it's 500,000. Last time I checked, it could have changed. They do change it regularly, but last time I checked, it was around 500,000. And if you are a business that does business in China, depending on the nature of how your cash is acquired or the nature of your business, you might be subject to those limitations. So you would probably either need state approval for that cash to come out. Now, how is that reflected in GAAP accounting? Well, currently, it's not. That's a problem. So if you're just a retail investor who has no idea, you're looking at the cash on the balance sheet and you're thinking, well, that's cash. Not true. Cash is supposed to be liquid and short-term readily available for short-term expenses. And if it's in China, though, if it's anywhere else, it's fine. But if it's in China, there's that little asterisk that should be there that should say, hey, we may or may not be able to actually take that cash out and pay our current bills with it, because it is subject to State Administration of Foreign Exchange. Okay, so we're going to get into specifically the implication of that in future videos, but just some food for thought. And then why does that affect crypto? So this crisis is kind of like a new Lehman Brothers moment for China. Let's use the Guardian's wording for that. But essentially, this could cause a little bit of a short-term panic, maybe a credit squeeze in China. And a lot of cryptocurrencies are used by Chinese citizenry, even though it's banned, to get their money out of China. And a lot of consumption of these cryptocurrencies done by Chinese citizenry in order to move their wealth outside of China beyond the $50,000 limit. They do a bunch of creative ways, and jewelry, stuff like that, but cryptocurrency is one of them. So if there is any form of liquidity crisis in China, that could put a short-term effect or negative effect on cryptocurrency. We might do a video of cryptocurrency someday soon. Personally, I have no stake in cryptocurrency, but I'm what you call a sideline cheerleader for cryptocurrencies. But I personally have none of my wealth in cryptocurrencies. So that pretty much covers everything I wanted to talk about today. To summarize, Alibaba is a great business, but regardless of that, even though at these assumed growth rates, which I think are very reasonable, and I know the model says it's a buy, I wouldn't be buying it just simply because I can't own it. And so unfortunately for me, I don't stand to benefit from it because I can't actually place a value on something I cannot own. So the shares are actually, for me, valued at zero, unless that changes, in which case they have a tremendous amount of value. But going forward, I can't see myself investing in Chinese businesses. Now, what does that mean for us as American investors? Well, it means we need to wait and see what happens with this whole temporary debt crisis in China and what are the implications. Right now, there's not a lot of clarity. However, long term, I don't think this is going to be that much of a problem. It can spill over into some American businesses, but overall, I don't see it destroying anyone's portfolio anytime soon. So that being said, guys, thank you for tuning in. And this has been your host, Fabio, for Capital Mindset. Be sure to wait and see and subscribe to see our future video content, and give it a thumbs up if you found it helpful and you learned a lot about investing in China or some of the risks associated with China. Thanks, guys.